Welcome back to Storm Stock Solutions. I'm Grant Mercer. We're wrapping up a wild first week of February and an even wilder January. And the tone right now is simple. Volatility is back, and the so-called safe corners of the market just reminded everyone that nothing is guaranteed. Let's start with the weekly recap. According to reporting from MarketWatch, U.S. stock futures are under pressure to start the new week, sliding alongside Bitcoin after a massive late-week sell-off in precious metals. That move in gold and silver capped what was already a tumultuous first month of 2026. Layer that on top of a big debate about the next Fed chair and a backdrop of geopolitical tension, and you've got a market that's less focused on earnings beats and more focused on tail risk and policy uncertainty. Stepping back, the big story for January and this week is that the usual playbook didn't really work. You had a strong economy and, in many cases, solid corporate results. But as one MarketWatch piece put it, there's now a bigger risk for stocks than the economy or earnings. Shocks from outside the traditional macro data. Geopolitics, policy shifts, and sudden air pockets and crowded trades are driving more of the price action than the fundamentals would suggest. On the winners and strength side, this wasn't a classic up big week, but there was a clear theme in what people were reading and talking about. Personal balance sheets and big life decisions. One of the most read pieces, highlighted by MarketWatch's personal finance team, was the story of a 40-year-old who inherited about $400,000 and is grappling with whether to use that money to buy a house with her fiancé. That's not a ticker symbol, but it speaks to the environment we're in. Higher rates, more volatility, and households trying to figure out how to deploy capital carefully. Traders pay attention to these kinds of stories because they reflect the broader sentiment. People are cautious, they're thinking hard about leverage, and they're weighing housing versus markets versus cash. Now to the pressure points and risks, because that's where the market's attention really is tonight. First, that precious metals shock. According to Naeem Aslam's reporting at MarketWatch, gold and silver just went through what's being described as a roughly $7 trillion wipeout in market value. That's an extraordinary move in assets that many treat as safe hedges. The takeaway here isn't just about metals, it's about risk management. If your hedge can crash in a single session, it forces everyone from retail traders to institutions to rethink diversification and liquidity. That's why you're seeing the sell-off bleeding into other markets, as Mike Murphy notes in his piece on futures, Bitcoin, and even oil weakening. Second, there's the household-level stress that shows up in another widely discussed MarketWatch column. A couple in their 70s living on Social Security and pensions, trying to decide whether to take out a $50,000 loan or sell stocks to fund home repairs. That kind of dilemma highlights how higher borrowing costs, volatile equity markets, and fixed incomes don't mix easily. For the broader market, these stories are canaries in the coal mine. If more retirees feel squeezed, that can affect spending, portfolio allocations, and the demand for both risky and defensive assets. We also saw micro-level corporate risk in headlines like the Melania documentary story, where Amazon MGM's big investment translated into a relatively small box office haul. One film won't move the stock on its own, but it underscores a theme in the media and streaming space. A lot of capital chasing uncertain returns in a crowded landscape. When you combine that with a more unforgiving market for misses, consumer discretionary and media names remain areas to handle with care. Now, let's talk macro and policy, because that's the connective tissue for all of this. According to MarketWatch's Charlie Garcia, President Trump's nominee for Fed chair, Kevin Warsh, is not necessarily the easy money dove some market participants might be hoping for. Warsh has a reputation as being hawkish on ultra-easy policy, even as this White House wants lower rates. That tension matters. If traders are positioning for a Fed that cuts quickly and aggressively, but the incoming chair is more cautious about reigniting inflation, rate expectations could be repriced. And that can ripple through everything from high-growth tech to dividend plays to those precious metal hedges that just got crunched. Add in Isabel Wang's point that the biggest risk for stocks right now may no longer be the economy or corporate results, but geopolitical shocks, and you get the picture. The macro backdrop is not just about CPI and payrolls anymore. It's about headlines that you can't model easily and policy moves that may not align with market wish lists. For the bigger picture watch list, there are a couple of under-the-radar themes worth monitoring as we head into February. Joy Wiltermuth at MarketWatch flagged the so-called January barometer for stocks. The old idea that as January goes, so goes the year. But with a big asterisk attached this time. January delivered big swings, cross-asset stress, and sharp reversals. If that's any guide, 2026 could be a year where volatility itself is the main character. Traders and long-term investors alike will be watching whether February confirms that pattern or calms it down. Another sleeper theme is content and consumer attention in the age of the Winter Olympics. Mike Murphy's rundown of what's worth streaming in February points out that the games are putting a chill on new releases across Netflix, Hulu, Peacock, and others. For streaming platforms and parent companies, this is a reminder that global events can redirect eyeballs and advertising dollars, which can show up in subscriber metrics and, eventually, in earnings surprises, positive or negative. Looking ahead to next week, here's how to frame it. Cross-asset risk is front and center after the gold and silver shock. Futures weakness and pressure in crypto suggest a cautious tone into Monday's open. At the same time, the Fed narrative around Kevin Warsh is still developing, and markets will be trying to game out whether the path for rates is as easy as they once thought. Layer on top of that an elevated geopolitical risk backdrop and a market that just failed a set-it-and-forget-it hedging strategy, and you've got the ingredients for more choppy, headline-driven trading. So as you get ready for a new week, the key questions professionals are asking are, how much of this metals and futures sell-off is forced positioning versus a fundamental shift? How will expectations for a Warsh-led Fed evolve? And does February confirm that volatility is the new normal, or start to take the edge off? We'll be tracking those questions for you every step of the way. I'll see you in our next pre-open segment, where we'll dig into how futures are trading and what's on deck in terms of data and earnings. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer,